In San Francisco, and this is Bloomberg Technology. Coming up in the next hour, Apple doubles down in the Lone Star State. The company will invest $1 billion to build a new campus in Austin as it looks to add more jobs across the United States. Plus, a retail revival. The industry has been struggling, but the CEO of Old Navy says technology and data collection could be the keys to luring customers back. And could the secret to Facebook's revival be PayPal? We'll speak to one analyst who says the social network's new partnership with PayPal is a match made in heaven. But first to our top story, the Wall Street Journal reports aides have warned President Trump not to intervene in the arrest of Huawei CFO Meng Wanzhou. The president suggested to Reuters Tuesday that he might get involved in the case if it helps secure a strong trade deal with China. Joining us now for more, Bloomberg Tech's Mark Bergen, who recently wrote about Huawei's ambitions and outlook. And Mark, we're continuing to get reaction from the Chinese government, including a Chinese official who wrote an op-ed in the Globe and Mail calling this a premeditated political action. Tell us more about what we're hearing from China.
You know, I think that certainly Canada has been in a really particularly tough spot here. We're seeing a lot of activity in social media on China, like very nationalistic, anti-Canada. I think the Chinese government, like the Journal reported, has a lot of lack of clarity about what the administration is doing. This is a DOJ matter. Trump clearly wants to get more involved and uses it as a bargaining chip. It's, from what I understand, with at least U.S. tech companies, it's very tense, and there's a lot of concern about what retaliation.
Meantime, Huawei has frozen orders from its Japanese supplier. Why?
My sense there, our reporting from out of Japan was that the company is sort of a little bit turbulent, right? That it's unclear what they're going to do. This is affecting their largest business, the networking side. They are the second largest handset provider, but the networking business is the bulk of their $100 billion revenue. So it does seem like they're at a really large turning point in the company. They are they're private, they're secretive. Even in China, they're sort of known as being more secretive than Apple is here. So it's really hard to read the tea leaves.
Now, she's been granted bail. The president has been told not to intervene. Of course, there are several different political and diplomatic situations going on here between Canada and China, between the United States and China, between the United States and Canada. What is next?
You know, the reporting I did was back in Shenzhen and Huawei's headquarters. The company is trying to, like many companies, turn themselves into an AI company. And this is where they have a large advantage over certainly a lot of key players in China, like Alibaba and Tencent, and even some American companies. Their gift and strength has been hardware and equipment, and they've been building chips, and now these specialized chips that can work for really advanced artificial intelligence. So they basically process a lot of video surveillance footage and facial recognition tools, and that's something that the Chinese government is going in with their huge plan massively to support kind of smart city initiatives.
And it's part of the reason the United States has a national security issue with this company.
Right. And so I think right now the revenue is split evenly between Huawei makes half their money in China and half outside of it. I think we're going to see a gradual shift where they're going to have to rely on their domestic market much more for sales. They're going to lean heavily on things like the smart city initiative, whether it's the cloud and AI, selling equipment to build out that. That's really hard to see how large that market can actually grow.
All right, well, we will continue to bring you every twist and turn in this Huawei story. Thanks so much, Bloomberg Tech's Mark Bergen, for joining us. Well, Apple will spend $1 billion to expand its operations in Austin, Texas. The iPhone maker will build a new employee campus that is big enough to house more than 15,000 more workers. Apple also announced it'll build facilities in Seattle, San Diego, and near LA, plus existing sites in Pittsburgh. And Boulder, Colorado will be expanded. Joining us now to discuss, Bloomberg Tech's Mark Gurman. So, Mark, Apple already has some operations in Austin. Why double down there?
Right. This is interesting because in January, Tim Cook, Apple CEO, specifically said that the company would be opening a new headquarters in a new location, and he said it would not be in Texas nor California. This is going to be in a new place. This is going to be a big new initiative for the company as part of bringing their money back overseas because of the new, tax plans from the Trump administration. But instead, they announced that they're opening up a new campus, some new offices, not too far away from their existing Austin campus, which is their second largest office park in the United States after Cupertino, obviously. So it's interesting that they went back on that, or it's possible this is a stopgap announcement and the real new headquarters announcement is perhaps delayed to a later time.
Right. The company has said they are looking to expand in some place completely brand new. 15,000 employees, that's a lot of employees. Compare how Apple has rolled this out to how Amazon rolled out its plans for HQ2 and the fanfare associated with it.
So one big similarity and one big difference. First, the big difference is that Apple did not hold a quote-unquote beauty contest. They did not go to numerous cities and ask them to send in pitches. They did not create a public process for it. They did not keep updating people on their progress like Amazon did. But the big, similarity here is they both veered off in different directions than they said they would, right? Amazon sort of pulled a small bait and switch, moving from one major new campus to splitting it between New York and the outer DC, Virginia area. Apple went back on its word from a new location and major new campus and basically put out an announcement regurgitating a bunch of expansions that we already knew about in San Diego, Seattle, in the LA area, plus an expansion for an existing campus in Austin, Texas. So both of them, veered off of their original directions and sort of changed course along the way.
Even though it wasn't as much of a public process, though, don't you imagine Apple had private processes similar with each of these cities, looking for a place where it could get a deal?
Yeah, absolutely. We know for a fact that North Carolina, they were in talks with the city of Raleigh for their Research Triangle Park RTP for quite a while, and I know officials in North Carolina were sort of blindsided by the announcement this morning, quite surprised that Apple either did not announce a campus there and, quite frankly, basically just announced an expansion of an existing headquarters. So lots of surprise on this one all around.
Now, how political is this move coming at this time in the middle of a trade war when there's a threat of tariffs on the iPhone?
I think it's extraordinarily political. You have not seen Apple in the past be so open about where their different campuses are, their different offices are across the United States. I mean, we've reported over the years about many of them, but I believe this is the first time that they publicly touted their presence in Miami, their presence in Boulder, Colorado, Pittsburgh, Seattle, Culver City, here in LA, all these other offices that they've sort of kept under wraps. Of course, people knew about them. You saw job listings for them, but them putting those names out there in a press release and touting them with this coverage, I think, it says a lot about the sort of Cold War we have here with Apple right in the middle of the tariff situation.
Cold War. Bloomberg Tech's Mark Gurman, as always, thank you so much for stopping by. Coming up, while the uncertainty of Brexit may impact the UK, venture capitalists continue to spread the wealth over the country's tech sector. We will talk to one partner about the future of European VC next. And if you like Bloomberg News, check us out on the radio. Listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. One day after surviving a no-confidence vote in Parliament, UK Prime Minister Theresa May met European leaders at a summit in Brussels. May will try to convince EU leaders to make concessions on the Brexit deal that they've already agreed to. However, during this period of uncertainty, the London tech sector continued to attract investment. Over $2 billion of VC funding was invested into the UK in the second quarter of this year. According to a report from KPMG, that's more than a third of the $5.6 billion invested across Europe as a whole. Here to discuss, Alistair Mitchell, EQT Ventures partner. EQT Ventures is a European VC fund with commitments of just over $640 million. And Alistair, Theresa May has won this no confidence vote, but it's still very uncertain whether Brexit will happen at all. How is this uncertainty impacting the UK tech scene?
Well, I think let's not forget a couple of things. First of all, Theresa May, like 99% of the tech sector in the UK, is a Remainer at heart. That's the first thing. She knows, and the tech sector knows, that anything about uncertainty that limits immigration and talent and that makes it more uncertain for people to invest makes it harder for everyone to do business. So we all want her, effectively, to win out this. That's the first thing. The second thing is that London remains, as you said, the biggest hub for European investment. It's got more than 2x the number of dollars going in or pounds going in than any other European hub. So it remains, even over the last year and a half of uncertainty, still the strongest. And the third thing is that Europe and Theresa May and the tech sector all want this to be the softest possible Brexit. And that's the handshake deal that they've got to try and get it done. So that's the way they're going.
So there are many possible scenarios, but let's talk about two of the most extreme. Yeah. One, Brexit happened. Yeah. Brexit happens, how does that impact the UK tech sector and investment? Does the rest of Europe start to get a greater share?
Well, already at the moment, London and as the UK's loss has been the rest of Europe's gain. Paris in particular has gained a lot. A combination of friendly tax strategies, a great investment in things like AI, has seen it do really well over the last 2 years in attracting talent that would have normally gone to London. But that will start to normalise. Anything that gets resolved, whether it's a soft or a hard one, is frankly a good thing. I mean, if you talk to most people in London in the tech sector, they just want certainty and they want it done as quickly as possible, whichever way it is, and then we'll get on with it and we'll build great businesses.
Now, haven't some UK tech companies postponed hiring, postponed CapEx, while they're waiting to see what happens? Sure. And if scenario LPs. 2, Brexit does not happen, are they behind?
Yeah, they are behind. And this is like, it's put basically an 18-month hole and pause in these companies. LPs have not been investing. Certainly European LPs who have had uncertainty have pulled out of the market. So it has definitely caused a delay for everyone. Whether you're an investor, whether you're a company building, it's made it tough for everyone. But that said, London's still done pretty well, right? And Europe as a sector has done extremely well in VC returns over the last 2 years. It's actually outperformed most sectors globally in that respect.
How is this impacting your investment strategy at EQT?
We look for great companies, great founders, right? So and we've lived through many downturns. I started my first business in 2000. We've lived through 2007 to 2009. You look for great companies, they always get funded. It has made it harder for sure, but it's allowed funds that operate across Europe, like EQT, to back some really amazing businesses.
What are the up-and-coming Silicon Valleys of Europe that we should be watching? What cities do you think will become the next hotbeds in the midst of this uncertainty? Yeah,
for sure. Well, I think London's going to remain probably the number one for quite a while. Paris and Berlin are both. Berlin used to be a huge hub back in the days of the Rocket Internet days. Now they're recoming with a lot of amazing startups. Paris, as I said, with AI and a lot of deep tech. We've invested in a company called Tiny Glues there, which is amazing. And then you've got some really unexpected sectors like Estonia, right, which people wouldn't think of as huge, but is actually per capita deploying more venture dollars and more startups than anywhere else in Europe. Amazing companies coming out of that. And the Nordics continue to be, for gaming, mobile, the core of the whole of actually globally.
We've seen a big crackdown in Europe on big tech and on smaller tech. I mean, we saw crackdown from London regulators on Uber. Do you think Uber, a company that tried to break a lot of rules in a lot of different companies in the name of growth, can ever recover?
Well, it's a great question. I think, first of all, I mean, let's talk about Europe and tech. I think people have a slightly different view in Europe of what the European community thinks about tech. I don't think they see it as anti-tech, or protectionist. I think it's more in line with what Europe does about legislating on things like monopolies or on data protection for its consumers rather than being anti-tech. London Uber is a special situation with London Cabbies, who is an institution in London and quite rightly felt they needed some protection. And there was a personal battle going on between the London mayor and the founder. So I think it's a bit of a special, but these guys, companies like Uber, but also all the scooter companies, have learned that you have to work hand in hand with regulators, not just in Europe, which is for sure has happened in London, but actually in cities here, where the scooters got thrown off the street and then now are back, right, which is great. But they've had to learn how to be hand in hand with regulators.
So, quick last question: what trends should we be watching in European tech?
Right, what do we love in European tech? Well, we love health tech and femtech. More investment has gone over the last 2 years into that sector, and Europe is a particular hotbed for that with the way that health is funded there. An amazing company that just got FDA approval here called Natural Cycles, which is basically a pregnancy through AI app. It's an amazing way for women to control their health. We're seeing that across all sectors. So health tech and femtech is one, huge. Second one, AI and robotics. Right, these are big buzzwords. There's been lots of money going in, but actually in 2019, what we will start to see is all that money that's been invested now coming into our daily lives. The emails you get, the phone calls you get, the art you watch, look at, the TV, and even the music you listen to will increasingly become AI generated.
All right, Alistair Mitchell, EQT Ventures, thank you so much for stopping by. Coming up, it is now one of the largest media companies in the world. Discovery CEO David Zaslav speaks to Bloomberg about the changing media landscape and rising competition next. This is Bloomberg. Since buying Scripps, Discovery says it is now bigger and better, competing with scripted series, movies, and streaming services like Netflix. Discovery CEO David Zaslav caught up with Bloomberg's David Weston in an exclusive interview and talked about how the deal gives them size and scope to compete on a global stage.
We're trying to play in a space that others aren't playing. So when we pulled Scripps into Discovery, we became the second biggest TV company in America behind NBC Universal in terms of our reach across television and audience. But we have great brands that people love. We had it at Discovery, Scripps had it. When you put it together, we have 3 of the top channels in America for women: Food, HG, ID. We have the #1 channel for African American women with OWN. We have another top channel for women with TLC. Discovery's the #1 channel in America for men. But when you look at our channels, they're really affinity networks. They're super fan channels. People that watch HGTV or Food or ID, they watch it the way somebody who loves Fox News might watch it. So it becomes kind of like a home for them. And so in the quality nonfiction area in the U.S., we own most of the great brands, and we're fighting to even make them better. We're competing, if you want to call it that, because we are in the traditional sense, with companies that are entertainment companies that are in the scripted and movie business. And we create an ecosystem on the TV set, but we're really very different when it comes to direct-to-consumer, because whether it be HBO or Showtime or Netflix or what Bob Iger is looking to do with this great deal that he did with Fox in aggregating, an incredible amount of great IP, is all of that side is scripted movies and series. And so there's lots of consumers domestically and around the world that are going to have a choice of 4, 5, or 6 places to go for between $10 and $15 to get scripted movies and series. And a lot of the movies are starting to appear on all those platforms. If you want something else, that's us. We're a global IP company, and so we have natural history globally, Animal Planet, Science, Discovery. We have food, we have home. We have crime. With this deal that we did with golf outside of the U.S., we own the PGA Tour with Jay Monahan, Commissioner. We're in business together everywhere in the world outside the U.S. Today we announced that we did a deal with the European Tour, which includes the Ryder Cup in most markets in Europe, Latin America, and a bunch of markets in Asia. And 2 weeks ago we announced Tiger Woods.
Yeah, I saw you on social media. I looked on here, David Zaslav with Tiger Woods. What's going on? And here you are.
I got the most likes I've ever had.
I bet that's right.
But the strategy is all the same. It's like, how do we do the business we're doing, which is still a growth business for us, where we have all these channels, free to air and cable around the world. But then how do we take all that IP that we own and get above the globe?
David Zaslav there, Discovery CEO, with our own David Weston. Meantime, fashion retailer Gap has been struggling. Shares are down 20% amidst declining mall traffic, but a bright spot in the Gap portfolio is Old Navy. Bloomberg's Emma Chandra sat down with Old Navy CEO Sonia Singhal, who talked about how data and technology is driving growth.
It's a really fun time to be in retail and fashion retail. Old Navy's in its 7th year of great sales growth, and so we feel optimistic about this year and this holiday. And it involves staying true to who we are, which is all about fashion, fun, family, and value, and at the same time changing in this digital age. And that combination is what we're really excited about and what's driving our growth.
How much has technology changed what you're doing at Old Navy?
It's interesting. We've had a real awakening over the last few years on data, and it all started with us by focusing on our customer data. We have over 800 million customer touch points a year. It's an enormous amount of information. And as we've been paying more and more attention to that, we're finding many of the answers. Many of the solutions that we're bringing to the market come from our customer insights. So for example, this year we have rolled out buy online, pick up in store. We've rolled out mobile selling in our stores. That is also coupled with lo-fi fun in our stores with hopscotch and coloring tables for the kids. So all of those insights come from greater access to more data.
So being able to collect and harvest data to use technology, it's actually feeding into very tangible business decisions.
Yes, in fact, our store growth, we've really gained confidence around our store growth because our customers are saying, look, we love your brand. Our brand health is at an all-time high. Our product star rating sits at a 4.75. It's a very high number, and yet I want a store closer to me. And so, we've been hearing this, and we've been responding with more stores.
How does that play then with the drive to being able to serve the customer online as well? You've got an e-commerce platform, and obviously they still want stores. That creates cost for you, of course.
Well, it's a very ubiquitous relationship between online and stores. Our customer will start online in the morning, and she'll shop our site, a mobile site. She'll then come into the store perhaps to try on. But we have really focused on both channels. Both are really, really important. And we've been in the e-com selling space for 20 years now, which is a really long time, particularly in the value sector. So we feel like we have a leading advantage there, and our digital growth has been phenomenal. We've been really pleased with it. We just finished Black Friday, Cyber Monday, and some of the stats were really off the charts in terms of the sales that we delivered through our digital channels.
Well, tell us more actually about Black Friday to Cyber Monday and the fact that we are smack bang in the middle of the holiday shopping season, which is crucial for any retailer. How is it going so far for you? Are you exceeding expectations?
We're happy with our Black Friday through Cyber results, and it's really the 6-day period between Thanksgiving on Thursday to Cyber Tuesday. And we saw double the amount of sales on our mobile site. Really the mobile transactions really driving the growth. We saw our buy online, pick up in store reach an all-time high on Cyber Monday. And then all of this was driven through some amazing product, and we're really winning with differentiated product in fleece, in sweaters, in sleep, in jeans. And the drive for us was our fun promotion around our $1 cozy sock. And we sold over 4 million cozy socks over that 6-day period, which was super fun. I think that's like 2,000 socks a minute or something like that. So
that's a lot of socks.
It's a lot of socks.
But it was that kind of deal that brought customers to the store and also online.
That's right, exactly. So that was a real call to action. Our customers loved it, and we had a great Black Friday.
Old Navy CEO Sonia Singhal there with Bloomberg's Emma Chandra. Coming up, more of Bloomberg Tech. We'll talk about Amazon HQ2 backlash. This is Bloomberg Technology. I'm Emily Chang in San Francisco. Turning our attention to Facebook now, the social media giant, and PayPal could be, quote, a match made in heaven when it comes to online commerce. The companies first teamed up in 2016 to offer payments through the Facebook and Messenger apps, but they should now take the partnership deeper. This according to MoffettNathanson, which published a note saying the two tech companies need each other now more than ever as Facebook looks to monetize more areas of its business. Joining me for more from New York, MoffettNathanson partner and senior equity analyst Lisa Ellis. So Facebook's in a world of controversy. How could PayPal help them?
Yeah, so as Facebook looks to change its narrative a bit away from the controversy around privacy, the slowing growth in ad revenues. One of the obvious areas for expansion is expanding into online commerce, and that's where PayPal can really help play a role. Facebook's got this extraordinary user base, 2.6 billion users globally, with many avenues where they could potentially drive e-commerce over their platform, but haven't today.
I do have a chart here in the Bloomberg which shows the two stocks diverging, and this yellow line here in the middle, this yellow circle shows where Facebook missed on earnings over the summer. Give us some more specifics about how you think Facebook should beef up this partnership.
Yeah, so we've identified 3 areas in particular. Number one, PayPal could power payments in WhatsApp to start to drive a more commerce through the WhatsApp platform, similar to WeChat does, the big Chinese competitor to WhatsApp. The second one is in Facebook marketplaces, which currently is more of a Craigslist-style marketplace, but they could actually turn that into an e-com platform with PayPal powering that platform, similar to what they did with eBay. And then thirdly, doing contextual commerce through Instagram. PayPal already has some success elsewhere in Facebook, helping to drive commerce directly right in the middle of social media. And you can do a very similar thing in the Instagram environment, where there's a lot of sort of identification of new niche brands, et cetera. You have the ability to click through to buy right out of Instagram.
What do you make of the divergence in the stock performance of these two companies?
Yeah, well, it's probably largely about growth. I mean, PayPal is continuing to put up very strong 20+% earnings growth, kind of quarter in, quarter out. Whereas I know Facebook's been struggling, as you highlighted. They missed, and they've been struggling from slowing growth in their core ad business.
So, are there any other payments companies that Facebook should be looking to integrate more tightly with?
Yeah, so I suppose the competitor, particularly around the Instagram idea, is Stripe. Stripe provides some selected functionality for Facebook in Instagram today. And then alternatively, when they're looking at potentially the Facebook marketplace concept, Adyen, the very hot European big e-com payments company, would also be an alternative. It was Adyen that actually won the eBay business, or a portion of the eBay business, away from PayPal. Those would be the 2 big competitors.
Now, the overall promise of social commerce hasn't really delivered. It's sort of working on Instagram, but, you see other companies like Tencent in China where social commerce really is a thing, but it hasn't taken off among, in the United States. It hasn't taken off among these U.S.-based social networks. When do you think that will happen?
Yeah, you're right. It is still coming. It's still very early. I would say we're seeing pieces of it start to come. A big difference is that in the Chinese wallets, you can conduct a lot of your day-to-day activities, day-to-day commerce, like hailing a taxi or ordering takeout, right through that social media platform. And that's often what then drives, the bigger ticket purchases. And that's what we're trying to see flip. So, for example, PayPal and Facebook have experimented with that capability in Facebook Messenger, but you're right, it hasn't quite gotten the full adoption yet, but it's coming. I mean, PayPal, is really focused on monetizing their Venmo platform, and those are the exact use cases they're going after, like the Uber, hailing an Uber, ordering food, et cetera, these kind of day-to-day activities.
Just got a promotion to order Uber Eats via my Venmo app and get a discount. MoffettNathanson partner and senior equity analyst Lisa Ellis. Thank you, Lisa, so much for stopping by. Now, Amazon has told employees at its Seattle headquarters they won't need to move to the company's new bases in New York or Northern Virginia. This, according to the Wall Street Journal. The company's search for HQ2 and ensuing pushback has dominated headlines. Our next guest argues that Amazon is, quote, the best thing to have happened to Seattle in the modern era. Joining me now, Heather Redmond, co-founder and partner at Flying Fish Partners, a venture capital firm in Seattle. She's also the former chair of the Seattle Metropolitan Chamber of Commerce. So part of the reason, Heather, that Amazon was looking to expand was because of pushback in its home city. And now it's seeing that in these new cities as well. People are angry. What do you make of this reaction?
Yeah, it's very interesting. I think Amazon ends up being sort of a lightning rod for a lot of emotion that might be better directed at other targets. It's sort of an easy target in the era of President Trump and people's frustration with some of the the greater societal trends. But I do think you need to make a distinction between New York and Virginia. I think New York has come out and had a lot of noise around Amazon coming, and you've seen stuff about the helipad and gentrification of this area that's adjacent to Brooklyn. But in Virginia, the response seems much more muted and much more welcoming. So I think there is a difference there, and I'm sure Amazon was aware of that when they chose those two locations. But I think you'll see both regions over time really welcome the additional expertise and talent pool that will come as a result of Amazon locating there.
Give us some context here. You've said in the past that the environment for Amazon and to some of its employees in Seattle was unpredictable and outright hostile. How so?
Yeah, again, I think there is a tendency sometimes to demagogue around why are we having the societal problems that we have. I mean, obviously, we've had a homelessness problem up and down the West Coast, a lot of human suffering that everybody is concerned about. And so you look for what is the other big change that has occurred and how can you blame that change agent for what you see as societal ills. And I think Amazon has sort of suffered from that, partly because they've been largely a quiet company and they haven't done a lot to sort of publicize some of the positive things that they do for the community. I think that's going to have to change. I was looking the other day at sort of what is the age of Amazon relative to the age at which Microsoft had all of the issues that they did with antitrust and sort of being the bad boy of tech. And they're sort of comparable. So I think Microsoft is now 43 and Amazon is 24. And if you look back at sort of the 2000 era, that was when Microsoft was sort of experiencing their maximum kind of hostile reaction from the general population and from a lot of other companies. And I think that's happening to Amazon now. This has been a big issue in Seattle because we have experienced a lot of growth, and a lot of that growth is attributable to Amazon coming into the market. But it is a much more complex picture in terms of what are the effects of that growth. Are they positive? Are they negative? And I think Amazon has gotten all of the blame for negative and none of the credit for positive.
Now, one of your areas of investment is AI, and there's been a lot of controversy surrounding Amazon's facial recognition technology, its use by the government. There was one study by the ACLU which pointed out that the technology got the identification wrong of several members of Congress, including Oprah. Is this technology really ready for prime time and for use by the U.S. government?
Yeah, that's a good question. I think facial recognition, like a lot of computer vision, has uses and misuses. And I think this is where tech is finally going to face the slippery slope concept. I mean, tech has been very binary. It's very ones and zeros. And the world of law and policy is not. And so I think that facial recognition and indeed pretty much every broad use of AI is going to require some sort of regulatory framework that is going to be a little bit more of a slippery slope. And so facial recognition could be very good. I mean, most of us use it on our iPhones today, and we love the convenience of it, right? It's recognizing our face. But the use of it for mass surveillance is maybe something that we're not comfortable with. And so regulating what those uses are, and so far we really haven't done that, but instead we've seen engineers at the variety of companies sort of stand up and say, no, I'm not okay building a product that is going to be based on national defense as opposed to enabling human productivity. And yet the science underlying those two use cases is very similar, right?
Now, unbiasing AI is something that is very important work that needs to be done. Microsoft has made a call to action about this. We see examples where it doesn't work. Amazon had an AI recruiting tool that actually trained itself to reject female candidates. What do you think the industry's call to action should be?
Yeah, I think it's very important that we build diversity into every layer of the tech sector, and it should be in society generally, but right now most of the drivers of change are on the tech side. So, one of the things that we need to see is we need to see more companies have diverse teams, and we need to see the funders of those companies have diverse teams. So one of the things that we've tried to do at Flying Fish, where we do primarily invest in AI and ML-based companies, is really diversify our own team. And as a result of that, we've seen that we're investing in more diverse teams as well, and also that our companies that are not diverse want to be more diverse because they feel like they have a partner in us. And I think this is both a downside and an upside issue. So we talk about Microsoft's Tay bot that became very racist in short order as it was interacting with a lot of trolls online. And we talk about Amazon's recruiting tool. We talk about Google's facial recognition and apparently also Facebook and Amazon that have a great deal of difficulty recognizing people of color, and particularly women of color. And that has to do with biased data sets and biased algorithms. And so our chances of doing a better job on the data sets and on the algorithms are greatly enhanced by having more diverse teams at every angle of the sort of tech stack. So whether that's the engineers, whether that's the executives, whether that's the funders, and I would argue even the reporters covering the sector, we have to have those diverse voices. And some of it is protecting against the downside, but it's also capturing the upside. If you think of all the products that could exist if we were really addressing everybody's needs as opposed to just one segment of the population, you start to see a lot of upside in terms of economic development and profits for companies by addressing those additional products.
Okay. Amen to that. Well, as I understand it, you do have 3 general partners, 1 woman, which is you, and 4 venture partners, 3 of whom are women of color. So wanted to point that out. Flying Fish Partners co-founder and managing partner, Heather Redmond from Seattle. Heather, thanks so much for joining us. Coming up, trading startup Robinhood is rolling out a new perk for its customers. We will discuss the company's goals for expansion with CEO Baiju Bhatt coming up. This is Bloomberg. Time now for our feature on the future of money, where we take a look at different aspects of how the digital world will impact currencies as we know it. Robinhood Financial rolled out its version of a bank account to customers Thursday. The trading startup will now offer both a checking and a savings account option with 3% interest. That is higher than the rates offered by Goldman Sachs and Social Finance, both of whom have taken their shots at traditional banks with improved interest rates with little gain. Bloomberg's Julie Verhage sat down with Robinhood co-CEO Baiju Bhatt to discuss and asked how they can offer this substantially higher rate.
The way that Robinhood offers this is that we take customers' cash that's held in their checking and savings balances, and we invest them in a government-grade asset, so think U.S. Treasuries. The yield that we earn on those treasuries, we pay back to customers, and we believe that long-term this is actually going to be a profitable business for us, so we're very excited about it.
And then you also mentioned that there would be checking and savings. Now, would the checking account also come with, a debit card that where you could make the interchange fee off of that?
Correct. So we are offering a debit card that also is free of cost to consumers that comes out with Robinhood Checking and Savings. There's 4 designs, and it's issued in partnership with MasterCard. And so we have commercial agreement with them that we share in the interchange revenue, which is the other way that this product makes money.
And now, since you guys are able to go out and invest this in other yielding products, I'm assuming that this is different than, a typical checking account I would get at JP Morgan, where they're lending out that money instead, and it's not FDIC insured with this. Explain that background a little bit, and if customers should have any concerns that their money isn't going to be safe when depositing it into this account.
Absolutely. So Robinhood Checking and Savings is offered by Robinhood Financial, which is our broker-dealer, and it is insured by SIPC up to $250,000, which is the same insurance amount that's offered through traditional FDIC-insured accounts. So it has a lot of similarities to FDIC-insured accounts, but like I said, it's offered through our broker-dealer, which is a financially regulated entity as well.
After launching, originally offering free trading to your customers, you've done things like get into crypto, get into options trading, now getting into this. So it wasn't super surprising to me when I did my FinTech Trends piece last week, and a lot of people said that you guys are an IPO candidate for 2019. Does that seem a little bit too early, or do you think that's a possibility?
So First things first, we announced Robinhood actually 5 years ago this week in 2013 with the stated mission that our goal was to democratize the financial system in our country. So a very lofty goal, and we stated that the way that we were going to do this was by building a company that was insanely focused on customer experience and that did things a little bit differently, and that we made long-term investments in our own infrastructure by building an engineering-first company. So you've seen what that has yielded for Robinhood over the last 5 years, where a major step along the way we announced about a month ago, which was clearing by Robinhood, the first fully self-clearing broker-dealer in quite a while, and checking and savings is actually the first product that we built on top of it. So we're continuing to make long-term investments in our business and building a company that we hope is around 20, 30, 40 years from now. So we see that this stuff is steps along the path that we've set forward for the company. We are definitely considering an IPO. Timeline we can't talk about just yet, but as we announced about a week ago, we also have hired a CFO, Jason Warnick, who comes to us from Amazon. So we're continuing to build the business, and we're incredibly excited about the trajectory.
Got it. So last question then, something that all of us have been noticing more of lately is that the markets have been more volatile than we've seen the last few years. What impact has that had on customer behavior? Because I'm sure you guys see a lot in the data that you guys have from what people are trading, how often they're trading, how often they're logging in, and other things.
Right. So one of the things that has always been really unique about Robinhood's customers is that we tend to have customers that we view as more contrarian. And by that, what I mean is that on market dips, we tend to see more buying than selling behavior. And so we've continued to see that over the last, small bit of turbulence that we've had in the market. That being said, as we look forward, we continue to be, pretty bullish on the state of the economy as a whole. Unemployment is still very low, and so, we've seen behavior that's in line with what we've seen before.
That was Robinhood co-CEO Baiju Bhatt with Bloomberg's Julie Verhage. Still ahead, Bitcoin has taken a turn for the worse in 2018. Will 2019 be any better? We will discuss next. Instacart is breaking up with Whole Foods. Starting Thursday, the grocery delivery service said it will begin separating itself from Whole Foods and eventually no longer let its customers order from the Amazon-owned grocer. The Whole Foods Instacart breakup will take months to finalize, largely because of how closely intertwined the two companies have been. Bitcoin. It's been the roller coaster ride for investors and regulators. The cryptocurrency gained mainstream recognition after surging 1,400% in 2017 and then falling 80% in 2018. That is the cover story told in this week's edition of Bloomberg Business Week. Joining us now to discuss, Bloomberg's editor-in-chief emeritus, Matt Winkler. So, Matt, you've covered many wild rides. How does Bitcoin compare?
So, Emily, you may not remember because you're too young. In the late 90s, there was a magic 2 words called cash earnings. And that was the arithmetic, so to speak, used to justify the valuations of so many .com companies that went public, of course. And one of them, by the way, was Yahoo, which came out in 1996 as an IPO. And it appreciated 120 times its IPO price, and then it fell almost 80%. Sound familiar? And much of the NASDAQ, in fact, was a losing bet right until the financial crisis. Didn't begin to recover until long afterwards. So cash earnings, Bitcoin, there is a comparison that I think is valid, which is that where people can't find standard ways to measure value, otherwise known as intrinsic worth, they do all kinds of mental gymnastics to do that. And Bitcoin is a really good example of how everybody tried so hard to justify what it was doing when the closer they looked, they couldn't find it. No, they're there. Even Warren Buffett said, it's a joke. So we've been in this picture before, and I think the .com bubble that burst in 2000 is a good example.
Well, it took 2 decades to see the end of Yahoo's story, and it never did quite recover. This story asks the question, will Bitcoin recover? Will it?
So, I'm not clairvoyant, and that answer is way above my pay grade. All I can do is, as an observer, really just a newsman, look at this and say, all right, what justifies the valuations that we see in the marketplace? And when it's difficult to find the answers, that's when you ought to be pretty cautious.
Do you see Bitcoin fitting into the broader story of volatility that's happening right now, and tech volatility in particular?
Yes, to the extent that, when you have volatility, it's another way of saying there's a lot of noise. And when there's a lot of noise, there's a lot of confusion. And when there's a lot of confusion and a lot of noise, people have difficulty finding the signals. And so where we are right now is the difficulty of finding the signals in so much noise. And the noise, unfortunately, I think, gets only louder.
So let's talk about the signals. Where do you see value in Bitcoin or cryptocurrency more broadly, or maybe it's just in blockchain?
I think the latter is exactly where there is value. There's all kinds of excitement over blockchain because it is, a technology, a tool that people can use, and that in and of itself is where there's intrinsic value. So blockchain is something that I would spend a lot of time thinking about and its application.
Matt Winkler with a very valuable historical perspective for us. Matt, our editor-in-chief emeritus, thank you so much for weighing in. We'll check it out in Bloomberg Business Week. That does it for this edition of Bloomberg Technology. We are, of course, live streaming on Twitter. You can check us out at Technology, and, of course, follow our Breaking News Network TikTok on Twitter. I'm Emily Chang. This is Bloomberg.